How old are you right now?
I'm 52.
So at 50 years old, you
Yeah.
started really just investing at 50. Good. You are the best case study then, because the most discouraged people I see on my channel are I'm in my 40s, I'm in my 50s, it's too late, I've screwed up, I haven't started investing yet. Well, all right, Darren, crazy Canuck investor, check out his YouTube channel. We're going to be talking about all the different ETFs and stocks that you hold that you're using to transition in retirement. Currently, your portfolio is 330K. You're trying to get to 500K. You collect a pension, so you're not trying to get to a million or anything. And this is for your wife. Everything I'm saying, by the way, is in a video on his YouTube channel. Check that out. But there are 17 ETFs and stocks. I'm going to walk through each one. Everybody, please use the chapters below. I will be tagging each stock in every chapter. And we're going to be talking about a bunch of other stuff. So bounce around. This is going to be very much focused on the transition from growth to income oriented portfolio because he's in that transitionary period. He's what, 8 years away from retirement, right?
That's correct. Yeah.
So let's jump right into it. I'm going to start with the first one. I have it all listed here. You have XCI.to. Why did you pick that?
Yeah. So when I started investing, clueless, go to YouTube, in the rabbit hole. And one of them that seemed popular was this notion that your money can generate some income for you. So like any beginner, I thought, oh, let's see what this can do for us. So essentially, it's just generating some monthly income with a little bit of growth. That's sort of what 2 years of my journey's taught me. So I like that one because I think it's good for if I was young, probably not. But I only learned that a few years in. Later on now, when I'm looking at retirement, it's going to generate some monthly income for me. I don't have to do much with it. Throw money into it, it grows a little bit. And then if I want to, if it's growing, I can sell it and put it into something else.
Yeah, that one makes sense right now for you because you're 8 years out. If I was over 10 years, definitely not, but you're in that transitionary period. So I like XCI is my favorite, by the way. That's like, I don't know, like the VFV, the VOO of Canadian dividend type stuff. It's like got good capital appreciation. It's got pretty decent yields. And then the next one you have is you have HYLD, Hamilton Enhanced US Covered Call ETF. That's an actual, that's got an actual high yield on it. Why'd you pick that?
Yeah, so that's again, you've already interviewed Adriano,
Yeah.
probably one of the inspirations in the space as far as income goes. So most of my portfolio is designed for me just experimenting, like regular Canadian, like what do I do? Where do I start? I don't have a finance background. And what I learned is I had some money in one of those, really, really high yields, but the NAV was just destroying itself. And I did do a video on that. So what I like about HYLD is it's kind of like all inclusive. You put your money into it, invest in the other funds, and it generates some monthly income. Of course, you're giving up the upside, but me getting closer to retirement, I'm starting to think like I guess I'm transitioning too. So it's a good fund for that. It doesn't lose NAV, grows slightly, very small amount, but generates that monthly income. So kind of setting myself up for retirement there.
And this is where it gets interesting because I would have just stuck to XCI and HYLD and been like, that's my portfolio, or maybe added like one more in, but we have 15 more to go. This is where I'm like, what's going on here? So YTSL, I tried to find information on this like quickly. Is this Tesla yield share
Yeah,
or something else?
that's
Is it?
correct. Yeah, it's just an income oriented fund against Tesla. Um, Gave it a try again. This was just a bit of experiment. It now something to keep in mind too is when you look at especially on my channel or if you go to Blossom and you're looking at my portfolio, it's actually several different parts. So it's made up of my stuff and my wife's kind of blended together, and that's what passive's pretty cool about. So you
Yeah.
have to keep in mind that some of the things that you might be looking at might be in different accounts.
Yeah.
Um, and so that one is not one in the main accounts that we're funding right now, I guess you might say. But yeah, it was just a play on income more than anything.
Is everything in TFSA? Is everything in RRSP? Is anything in, or is it
A little bit of
income?
both. So the two main ones, the goal when I started was I wanted to take that TFSA from zero to maxing it out. If you listen to some of the intros I have, that was sort of where I started because I didn't know anything about investing, and I came from a generation where we didn't have a TFSA, and then hey, this thing is actually something we used to put money in, but like in a savings account and earn nothing, and I didn't realize I could invest in it. So when I realized I could do that, I was like, what I like about this is it's after tax dollars. I can make it grow. If if I take it out, I can put it back in the next year. So kind of an open door as far as that goes. And then I learned a little bit about, well, wait a minute, there's some things you don't want to put in that account. It should be going in your RSP. So that's why we're funding the TFSA and the spousal, because keep in mind, this is essentially my wife's retirement fund. And so using the spousal, I get to put some of my wages into her. She'll take out later in life. That's sort of the general rule of thumb.
On your channel, is the narrative and focus on a lot of the videos just documenting that process of that transitionary period, documenting how you're managing your wife's account, your account, TFSA, RRSP? That's high value stuff. I like that. That's hitting a core part of even my audience. Like, you guys should check this out if that's what you're doing.
Yeah, I definitely, like I said, like, how did I get to be this age and not really know too much about this? And yeah, I just want to share that journey with others. And it's funny because at work now, I get asked a lot of questions and I hear it from a lot of people that are on YouTube that, like, I think I heard Adriano say that he had explained so many times to people what to do once they realized you have a little bit of knowledge. And I have very little. But to repetitively explain it, it's easier to just share it. That's what I learned about YouTube. So even this experience with you is kind of one of those, kind of a test for me too, I think, because at 2 years, I don't have a great deal of knowledge. I am literally the grassroots Canadian that didn't know anything 2 years ago.
So that's interesting. So how, if you don't mind me asking your age, how old are you right now?
I'm 52.
So at 50 years old,
Yeah.
you started really just investing at 50. Good. If that the case, actually?
Absolutely, it was. That's exactly how it happened. So the story behind it is my father-in-law managed my wife's accounts, and we've been together for some time. And I guess I just took it for granted. My parents had helped me earlier in my life with some of these things. I had a small RRSP, but because I had a pension, I didn't worry about it. And then my father-in-law passed away, sadly, probably in a better place. But at that point, it was like, well, what's there? I don't know. And then I started from there. And she was in some mutual funds. Look, what's a mutual fund? I didn't even know. And that slowly snowballed to today. So I literally came from zero knowledge. I mean, I knew what an RRSP was in a TFSA for the basic stuff, but beyond that, nothing else.
You are the best case study then, because the most discouraged people I see on my channel are, I'm in my 40s, I'm in my 50s, it's too late, I've screwed up, I haven't started investing yet. Well,
Yeah,
you
no,
exist.
yeah, exactly. No, it's funny because I was looking at what I've put into, like, what we dragged out of the other accounts to bring it over and how it's growing. That $100,000 does make a big difference. That the dividend side of it, I think a lot of people, if your viewers are on Blossom, and if they're not, they probably should be. It's a great place to share and learn and stuff and connect with other YouTubers. But a lot of people think that dividends might be the best way to go, but I think the reality is different strategies for different people in different times of their life, and that's the important part to learn. Like you were mentioning earlier, was like, I might not want to invest in a fund because I'm younger. In my case, I might want to because it might generate some income for me. So you have to learn the basics, and there's a lot of other basic things too about debt and all that other stuff. But anyway,
Man, okay, I guess I'm going to drive this point home. If you have ever been someone who's commented on my channel going, it's too late to invest, then just please check out the Crazy Canuck Investor, check out Darren's channel, because that's it. I love case studies, are the best. So I recently started doing a case study of, I have 100K in covered call. I talked to Adriano, he brainwashed me, and I thought, okay, I thought, okay, it's some voodoo he did on me. But I was like, I was already doing this with like UMAX and other Hamilton covered call. I was taking my emergency fund of 100K, and instead of putting a GIC, a high interest savings, I'm like, hey, I'll just put in covered calls. It's in a non-registered account. I know all the tax implications. I know all that stuff. But it was really like, I have a marketing background. I like doing split tests. I like to see A versus B, see what performs better. So now I'm just doing this like every month. I'm making changes to it. Like, I just released a video a few days ago as of us recording, that it's already changed. Like, it's gonna look different next month, where I'm seeing, can I redline this thing to have it outperform my traditional 3 ETF portfolio that's growth orientated with VFV, right? So I wouldn't ever recommend that to anyone else though on the planet, other than maybe you, because you're transitioning. But me as a 39-year-old, I would never normally do that. But in my position, what I'm doing, it makes sense. It runs a case test. It's a good case study. I have a YouTube channel, more content for me to document. Like, there's multiple things I can do with it. So that's why it makes sense.
it's interesting you say that. So from the beginning, when I started learning, and again, I keep saying his name because Adriano is sort of in this space, and specifically about income oriented investing. That's so, and he doesn't, he's very truthful about losing the upside. So if you're trying to grow your portfolio, but what I thought was interesting is things have changed a lot. I heard something interesting about him when he started, like a long time ago, that he had no subscribers like most of us in YouTube, but then even the space of the covered calls themselves has changed a lot and the knowledge in them. So I started a series as well. It's a very small portfolio, but I figured it would represent someone who might be a regular Canadian that like, oh, I want to try this. It's sort of the same notion that you just described is, can this really income, as long as you're reinvesting it? I think that's the key too. If you're going to live off the income that's generated from it, it's probably not going to see the same growth. But I'm curious too. I'm still a non-believer, not 100%,
Yeah.
but we'll see.
It's that nav erosion and stuff that gets me. So like, I think with this, it'll be a good case study for me is what best case and worst case scenarios look like. Mine will either fail so miserably or work so well, and no one ever has to use a dime of their own money. Right? Don't do any of what I'm doing when it comes to that portion of my portfolio. Just watch and see the train wreck or watch me succeed. It's one of the two. Let's move on to the next one. We have TD.TO, Toronto Dominion, another single stock. Why do you pick that one?
Yeah. So again, everything's going to come. I'm going to repeat myself a little bit in the sense that if you're watching this, you're watching Gary and I talk, and you're wondering, like, should I get started? You're going through what I went through 2 years ago. Okay. And I didn't know. So you'll see in this, where we're going to go through all these, that you've got some covered calls, you've got some single stock positions, and you've got some ETFs. What I can assure you of is that I'm now realizing that the ETF approach is likely the best approach. I'm no financial expert, but that's kind of where I'm going. So TD, we were customers of TD when we started this when I was 50. And so the basics I learned about, if you're going to pick a single stock, you need to know something about the company. Well, I've been a customer with them since the 90s. So I know enough about the big banks, and I knew enough about TD that I thought, okay, I think I trust this company. We've been using it. And if you look at some graphs or charts about these stocks, you can see that they're steadily growing. They steadily grow their dividend. And okay, so as a basic beginner, this seems like a reasonable one for me to put some money in. I'm probably not going to lose my money. What I mean by that is, if you invest in a startup company and 2 months down the road after the big hype, all of a sudden it drops off, you lose your money. So
I said you just saved people a lot of money with that one thing, though. You said you were familiar with TD, you knew TD. That was a safe starting point. That is like the crux of my investment thesis. I only invest in things I know thoroughly, I trust, I'm aware of, I use them, I'm in their ecosystem. That's why I always kind of reference Google. I invest in Google. But the reason why I went with Hamilton ETFs is because through advertising back in the day, I knew Hamilton. I knew what their management looked like. I was so familiar with them. I knew I could trust them with a covered call strategy. I knew that they're good for the money.
Right.
Paid on time. Right. So there was that. And it's like, if you do that one simple thing, you basically eliminate all startups. You eliminate all penny stocks. You eliminate all dumb investments, because you're going, well, do I know this company? Am I super familiar? You could talk to people about TD, right? You've been using them for years. That trust is built in.
Yeah, and it's funny because now, having looked into this stuff a little more about the institutions themselves, one of the keys, at least in my experience as a new investor, was, we talk about saving money because you want to put it away for the future. Well, you don't need to be poor, okay? That's not how this works. That 2 years of this has taught me, like, okay, we don't need to be poor, but there are ways to be creative with what you do with your money. And so, Wealthsimple, some of your viewers are likely familiar with Wealthsimple. They're actually a financial institution now. It took me a bit to figure that one out. This was learned from picking a broker. One of the first couple of steps, you got to pick a broker. And that led me to like, well, what other options are there to manage my money? And obviously through YouTube and others, EQ Bank came to my attention. So eventually I realized, like, we're paying a lot of fees with these big banks. And what do you get in return? I don't think we get a lot. And so I went to the bank and said, listen, and I did a video on it, but hey, look, are you guys going to match what I can get at these other institutions? And the answer was no. And I've been with them since the 90s. So that loyalty wasn't rewarded in any way. off we went, and we've moved our money. And again, I'm dating myself. I know I said I'm 50, but when I grew up, you actually went to the bank with your money and your
Yeah.
bank book and all that. Now I can literally sit here right now, talking to Gary, and make a buy or move money around or whatever I want to do. So to your listeners, when it comes to knowing companies, the company that I started to know about was EQ Bank. I'm like, oh, these guys have some good things. They're growing new financial institutions. So I haven't invested in them yet, but indirectly I am through ETFs. So
That's good. That's good. Let's move on to the next one, which is probably my favorite one on the planet. Yeah, it is. VFV.to VOO. They're I literally one investment you can tell anyone to ever buy that is good forever. I think it's good forever is VFV. Why'd you pick it?
yeah,
I picked it
again,
up.
so when I learned about the stock market and what that all means, like when I grew up, I knew about the different, the Dow Jones and all that. It was on the TV. It was the ticker that went by. I didn't really know what that was all about, but understanding a little bit more about what the S&P 500 actually is and what those companies are and why that and for your viewers too, I'm sure you've spoken about it in some of your videos, but VFV is a basket of stocks in that tracking the top 500 companies in the United States. That said, there are other ones out there like ZSP. So it's like buying a Toyota or a Ford, and they will manage those funds slightly differently. So it's important to look at how they each perform against each other over longer periods of time, not in the short period. So that one was a no-brainer. A lot of people talked about it when I looked at the growth, same thing, chart stuff. It made a sense to put money in there, especially when I wanted exposure to, like you mentioned, Google and all the big companies, because I get it indirectly by investing in that.
It's what are you going to do with VFV when you're in retirement? Because that is still a growth stock. You're not really, there's no real dividend on it.
No,
What are you
there
going to do?
isn't. So there's a couple of things I've thought about when I get to retirement. So, you can start selling. It's continually growing. So it's not like when I sell it, it's unrealized gains right now, but it'll be realized then. It'll be worth more. I can then flip that over into a fund like HYLD, which will then generate some monthly income. So that would be one way to do that. And then, of course, if you're looking at some fixed income, that may or may not be part of the strategy. I could look at some of those things. So essentially, as I get into or closer to retirement, we're going to transition. But one thing I learned recently that I think is important to keep in mind is I say I'm retiring at 60, but that doesn't mean that I don't have more time of investing after I retire. So that growth, what I thought was 8 years, and if you watch some of my recent videos, I talk about it, it's probably not. It's probably more like 10 or maybe even 15 years. It depends on how big the portfolio gets. The last video that I did, I use a tool that will tell me how much the portfolio, reasonably be worth, and it's far more than I said the goal of 500,000. So yeah, we might want to keep that growing. I have two kids. We're probably going to have to look at passing that on. Now we do have an RESP, but so those are some things I'm thinking about. That time frame is actually a lot longer than I originally thought.
Let's talk about that time frame. We were talking off camera how I think I'm going to live till 200 and all that stuff, right? Hey, I really do. And by the time this podcast gets released, people will see that there's like a longevity podcast. People will see that I had talked to Passive Canadian Investor, another YouTuber, and he had a portfolio he did for his sort of what he was thinking of like a mock portfolio for retirement. He kept VFV in there. He didn't because my original plan was take VFV, convert that thing in the last 5 years to a high paying dividend yield, just milking that thing for crazy 30,000 a month, something rate income.
Yeah.
But then I'm thinking, wait a second, I'm not dead at 65. I'm not dead at 75. If I'm a dude who thinks he's going to live till he's 200, wait a second, I'm still a growth investor till I'm like 100 and something. So I changed my whole thesis has changed now. I'm going, maybe I'll just hold on to VFE, sell a portion of it,
Exactly.
25% off the bat to be like, I want to officially never do anything anymore after 65, but I'm a growth investor still primarily, but I've just accrued so much growth up to 65 that I can actually now technically be both.
Yeah.
Heavy dividend invest. That's what I'm thinking now.
So another thing too for your viewers is something else that's important to consider is this notion of the asset allocation. What does that mean? Well, how much of the pie do I want in each one of these? And this particular fund, for me, it's somewhere in that 35 to 45% range of the whole portfolio. So the numbers that you just talked about, yeah. Let's say I'm 18, because those are the people that I really want to benefit from this. But let's say you're, I don't know, in your mid 30s and you have young kids. I want you to influence your kids by watching our videos. But that VFV over time is going to become huge part of your portfolio. So like you said, you only need to sell a portion of it to then start generating income. It could be $50,000. You never know.
Yeah.
And you made another good point, which I think is interesting, is so the calculator that I use asks you to put what age do you think you'll live to? If we had asked that question when I was young, people might say like 70, maybe 80. Now we're seeing people living into their hundreds. So nobody really knows. So that's an important number too when you're looking at how much money I'm going to save for retirement, because you might retire at 60, but you might live to 100 plus years old. Got to think about that.
If you live a relatively healthy lifestyle, you'll probably live till you're 120. I interviewed the CEO of Longevity Life Science, a guy named Jerry Kroll. He's also CEO of electric vehicle company. This guy is like highly established. This guy knows how to make things happen. I downloaded his app, the Longevity app. You should download it if you have an iPhone or an Android. And there's a little test you can take. And it said, hey, you're going to live till you're 122 without any sort of, I don't drink, I don't smoke. Right. So that's a pretty easy one. And I work out a couple days a week. I'm not that sedentary. So there's a couple things working to my advantage there. So I was thinking, okay, now I got to, at a bare minimum, if I don't get hit by a bus, I should start planning around that a little bit. Cause I want to be one of those guys where I hit like 120 and then my health goes to shit. I have 2 years of bad health, but I'm pretty good all the way up until that point.
Yeah.
So, which means now I got to kind of rearrange my brain and how I think about finances where,
Well, and there's a lot to be said too. So if you're opening this, I know you want to talk about all my ETFs, but this is great because it's making me think about stuff. So there's some interesting, I was going to say studies, but I might not be able to back that up. But the bottom line is when people retire, you change. So you go from, I'll just use the average example. You have a 9 to 5 job Monday to Friday, and next Saturday you retire. What's your plan? Mentally, you're going to change. Physically, you're going to change. So you have to think about all that stuff. Now, let's take what you just said, 60 to 120. What are you going to do in all that time? Now, I think after talking to you for a few minutes, I get where you're coming from. You could do this stuff. Even myself, I see this as an exit strategy when I leave. And in fact, the people that I work with could benefit because there's always new people coming in. That would keep me mentally stimulated and physically going. Because a lot of people, they retire and what happens? Poof.
Yep.
That's the end because they got nothing to do.
Yeah, I 100% agree. You need some sort of purpose after retirement to keep you going. If you don't have that, you'll just fall apart. They see that. What's that? Another imaginary statistic. It's, people health declines 10 years after retirement for most people because they got nothing going on. Right?
Exactly.
You can only travel and eat good dinners for so long before you become bored of it. Right? You need some sort of structure, something to work towards. Both my parents are retired, but they have grandkids and stuff, and we keep them busy with that. And
exactly,
they got a little community of other old people. Like I tell my parents that they're running a senior home at their house now because it's just like when I go to visit them, like they live in Victoria.
Yeah.
Every time I go to visit them, it's just like them and like a group of seniors that just congregate at their house and hang out. So I'm like, okay, they're good. They created like a retirement home. Funny thing is, my parents actually worked in a retirement home their whole lives.
Oh, really?
There were those care aides that would take care of elderly people in retirement. So now they're running their own facility with family.
Oh, wow.
Yeah, it's technically. So so that's that. Let's move on to another one I'm not too familiar with, rei.un.to, the RioCan Real Estate Investment Trust.
Yeah. So again, we'll talk about asset allocation and different funds. I've always wanted to own some real estate. In fact, at one point in our life, we had moved and sold our home and had the money sitting around, and we were looking at an income property. So it kind of came from that idea. And then when I did a lot of my research, and again, like I didn't just watch one YouTuber, I watched a bunch. I didn't just watch stuff. I went and listened to podcasts and read books, and that's really important. Don't focus on one thing. But real estate, I think, is an important part of your investing, and to concentrate it, which is what REI does. Most of those funds are paying out, 90% of the returns on them. So this company, they invest in lots of various commercial real estate with strong brand names as their customers. It's not a huge strong performer if you were to research it. Like it's not going to compare against VFE, but it does generate its monthly dividends. So that's one of the reasons I did it. I keep my asset allocation tries to keep that at about 5% or less of the whole portfolio. So that's kind of where that came from.
There's a clip on my channel. I talked to Bassam, the Canadian finance pro, and he's a kind of a REIT expert. He knows a lot about it. He had a lot of criticism for Canadian REITs. I clipped it out actually because I thought it was like, wow, this is because I'd actually worked for REITs in the past, but I never really knew about what's the inner workings of the corporate life.
Yeah.
I've done advertising for them, and if you watch the clip, it's just him saying how, the C-suite is really benefiting from it, and there's a little bit of corruption happening, and they're sort of siphoning cash from it. And then I talked to Canadian passive investor, and he said, because he's friends with Bassam, he said he invests in U.S. REITs, not Canadian. So he sells those REITs, but he just decided to go into the U.S. REITs instead.
So it's interesting. So it brings me to another point in investing. So you can take two strategies. It can be all Canadian funds, right? It's easy for us. I use Wealthsimple and Questrade, although primarily Wealthsimple. I can just invest all day in the Canadian funds. But the American dollar has always been stronger. And so one of the other things I learned is it's great to sort of try to convert your cash. And that becomes a whole other conversation of how to do that. So I do have VRE, which is in an RRSP, and that is American. And I did hold at one time, if you go back and watch my earlier videos, I had an American REIT. The name of it escapes me off the top of my head. But you have to convert your cash to make it work, or you have to invest indirectly through a Canadian fund that then invests into that fund. But that's an interesting point. I would never have known that until you said that just strictly American ones might be a better option.
I don't know if it affects returns that they're doing corporately shady things in the back. It might have the same returns. It might be all fantastic. I think it's just an interesting fact I tell people now if they buy REITs. It's like, you should watch that clip. Because I guess I didn't know. And I've been doing this for, 5-6 years now in capital markets working. I'm like, how did I not know about this? But he's so deeply entrenched, especially from the accounting side, that he would know this stuff. So I was
Right.
like, okay. Which is the benefits of interviewing people on a podcast. You learn these things. Have you ever, for the conversion, I don't do this anymore. I used to do a lot, Norbert's Gambit. You ever tried that technique?
Yeah, no, that's exactly. So that's what I say is, so there's two ways, and I have on my YouTube channel, you can go and find the two different methods that I use. So the one you're discussing is simply taking Canadian fund, you buy it in Canadian, and they'll journal those shares over and they become US funds, and then you sell that. They usually charge a fee. In Questrade's case, it's like $10. But if you use Wealthsimple to do the same thing to straightly convert your money, you're going to get charged 1.5%, which again, it erodes your sort of, that's where you can cut those fees. So that's how I do it right now, as I do it with Questrade. They recently made a change though, to their platform. I'm not super happy with it. There were some suggestions that using National Bank, I think it is, there's no fees for it. I'm not convinced that's completely the case. How's the institution going to make any money? But yes, so Norbert Gambit, that's how I do my conversion. The other way to do it is you can convert your money. So I do it on the EQ Bank side, just within their platform. So whatever the rate for the day is, and there is a small markup, negligible, I would argue. Then once you have your American cash in your US account, then you can fund directly into certain accounts. But not every institution allows for that. For obvious reasons, they need to make money. So that's another way you can go about converting your funds to then invest directly. And we talked about via V and VU, then you would just buy VU directly instead of buying via V.
Great. That's great information, actually. All right. Now moving on to the next one. We talked a little bit about VRE. I think you mentioned that as the Vanguard FTSE, Canadian Capped REIT Index ETF. Anything else you want to add to that one?
No, it's the same thing. Like I said, I love the ETF approach. If I really wanted to study the single positions, it would take me forever. Because I invested in them originally, I've whittled some of them down and eventually will probably get rid of a lot of them. But that takes some time to get to that point. So VRA, basket of REITs, easy, put my money in, watch it grow. And again, monthly dividends from that one.
CNQ, Canadian Natural Resources Limited. I like this one. I just don't own it. That's a good one to own.
I'll be honest, I know it's a resource energy company. I don't look at their books, but a lot of people were talking about it as a single stock position when I started, and it's done very well. And it is, if you go on to Blossom, or you'll hear a lot of people talking about it. But yeah, it's performed well, so I just didn't get rid of it because it performed well. But I do have exposure to it through XEIC, so
That's the thing. Like, from a management perspective, I could just see you scraping a lot of this stuff down, getting rid of. You have 17, getting down to like 7 or at least 10, right?
yeah.
So maybe if something's way up, you're like, maybe I'll hold on to this because you got in at such a good price. But here's another one, another REIT. Maybe I'll blast through the REITs here. You have plz.un.to, the Plaza Retail REIT. Never heard of that. It's an open-ended REIT focused on Eastern Atlantic Canada with 211 properties. So
Yeah.
Reed is really into REITs at some moment, and you bought a bunch of different
It's
REITs.
the same thing as REI. It's kind of like almost a smaller spin-off of it. They're not associated in any way, but it does sort of the same thing. Um, the reason that I started investing in this one, again, thinking like a beginner here, 2 years later, maybe I wouldn't have done it. I don't know, but the share price is really low. Monthly returns on it. It doesn't grow a great deal, but they're a solid company in Canada. Like they're not really going to go anywhere as far as I can tell. So if I had extra cash kicking around, and when I started, there was fractional shares was not as easy to come by purchasing. Taking a sidestep, VOO is a very expensive share price. There's some of them that are very, very expensive, over $1,000. Well, most of us wouldn't be able to purchase that. So if I had extra cash and I couldn't do a fractional share purchase, I'd put a little bit of money that was kicking around into this thing, and then I get some monthly returns from it. Again, it doesn't grow much. The share prices pretty much remain the same the entire time, but I get that monthly income from it. Yeah.
The logic makes sense. I get what you did now. That's sound logic because you're saying you're a new investor. Are these what you mainly bought when you first started investing? Have you got rid of
I have, yeah. I've definitely got rid of some, yeah.
any really bad investments? Because to be honest, none of this stuff is like I've made some really dumb. Like when I first started, like a little bit impulsive, a little bit more speculative. None of these are bad. So
Yeah,
were there any obvious bad ones you made? Because this is pretty good for a guy who's new to investing. It's like, yeah, you overbought, like you have too many probably, but you don't have any bad. Like I had some random stocks when I first bought. We're going like, what am I would never even consider now.
no, I mean the basic thesis was if I don't know the company,
Yeah.
definitely not. If there wasn't enough chatter about it that I would watch, listen to, or learn about, it wouldn't attract my attention. So like the idea of penny stocks, yeah, it's kind of neat if I had extra time, but I don't. So I never did any of those. And when you ask if I had a really bad investment, listening to Adriano's channel, he goes over a lot of the covered calls, and some of them have these gigantic returns. So I tried that with QQQY, and I did a video on it. You can find it in my playlist. That was, yeah, watching the NAV just like desecrate, just destroy itself was brutal. And eventually, I think I held it for about a year. And Adriano's perspective for him is those dividends, when returned, are total returns. The truth is, yes, at the end of the day, even though the NAV is going down and your dividends, you're making a small amount on the top, but there are better funds I found to invest in. So that one got trashed pretty quickly. But as far as like single stock and ETFs, most of them, no, I've modified them maybe slightly, but and then like for instance, I think you might come across the CN one. I didn't buy CNNCP. I did do a video on it, but I think initially I thought I would buy a single stock because I know the company and I want to see how this works as a new investor. But now knowing the amount of time and effort that has to be put into make the right choice between the two big railways in Canada, I don't have that kind of time. So it's better. That's why I realized ETFs are a better way to do that. I get both of them in one ETF.
Yeah, I agree with you. Let's move on to this next one here. ATD.to, Alimentation Couche-Tard.
Alaman Couche-Tard, yeah.
Alaman Kushtar. Wow. Okay. Growth strategy with global expansion, global convenience store operator with 16,800 stores across 31. Okay. Circle K. Okay. Okay. Cool. Yeah.
So
I talk about this.
in hindsight, had I have known more about the company, would have made a lot of sense. Some would argue we're going into a recession. I would argue we're in one, okay?
Yeah.
But
Yeah.
places like this, like for instance, recently Circle K started doing Amazon returns. So when we want to return something, we zip over to the old Circle K, we go, here's our stuff. Oh, I need a bag of chips. And I get that at a higher marked up price. So that business concept does well in, I would suggest, economic environments like we're seeing right now. And their stock has done very well. Again, though, you get the same exposure to that through XIC or other ETFs. But yeah, lots of chatter. Now know what it's all about. So I thought, oh, I'm going to hang on to this one and see where it goes over time.
You get the same exposure, but now you're just more concentrated
Yeah.
that you have ATD. That's interesting. I don't know if this falls into the same bundle. I got really close to buying dollar store stocks, the dollar stores and all that,
Yeah.
because they hit a crash, and I was like, I think this is gonna bounce. I think they did bounce back. I haven't looked at it in a while. But I
Are you
was
referring to Dollarama or Dollar Store?
can't remember. Probably dollar around. I can't remember.
Dollarama is another one that people like to hold.
Yeah. So I was looking at all those sort of dollar store type things. So I'm thinking like, I'm like, these will be around for a while. And I think I was thinking, I'm like, they'll do really well in like when the economy's suffering and stuff like that. So I was like, all right, let me take a look at this. I never pulled the trigger. The amount of research I do is sickening. Before I didn't do heavy research on the H8 on my covered call. I let Adriano kind of do it. I sort of just like, all right, you kind of did that. I'll just kind of pick a couple things and do real time testing. But when I actually buy stocks and I start putting a lot of money on it, it's a ton of research that often leads nowhere. I go, great. Now I know everything and I'm still not buying. Like it's all like almost always happens. 9 out of 10 times that happens. I spend a countless amount of hours and I don't buy anything.
I think that that's the notion of gambling. I use that in some of the posts that I've done on Blossom and some of my YouTube stuff. But what you just described to me as a regular average Canadian who probably knows less than the average guy in investing, that sounds a lot like gambling. Even though you did all this research, that company could go belly up tomorrow. I mean, maybe not,
You know
but
what it is? Do you know what actually eliminates it? I'll dwindle it down to where I'm positive they'll be great 5, 10 years actually. And I know that they'll be around. Like it's always companies that I'm like, okay, great. When they make it to that final stage, when I'm 10 hours deep into research or something, it comes down to how confident am I that they're going to outperform the S&P 500 for the next
yeah,
5 years. The criteria, it's not even at this point. It's not even like, am I going to make money? It's like I'm not going to buy you unless, and you know, my benchmark on my internal portfolio is 20% or higher. So I don't buy anything unless I'm going to get a 20% or higher return
right.
that year.
Yeah.
And for the next 5 years, I don't buy anything other than VFV, because you know that'll go up and down, and that's the one I kind of lower my standards. But
Yeah.
if I'm not doing anything, like my portfolio right now is up 30 something percent this year during a market crash. Like it's wild. This is my investment strategy. So that's
I
sort of how
think
I go about it.
so. I should start taking notes. So I'll go to the Dollarama because Dollarama follows the same notion as Alaman Couche-Tard in today's economic environment. So to prep for this interview with you, you had asked me to wear the headphones, and I was like, oh man, like I don't have the dongle that I need. So anyway, I went to London Drugs. London Drugs is a phenomenal company because the staff can really help you understand things if you don't know them. I'm like, oh, I need this dongle, so I bought it. And then I came back because I had to buy something else, and I realized, wait a minute, I wonder if the dollar store has this thing. And sure enough, I went over there and they had the same dongle, which I'm using right now, and it was a fraction of the price. So when you're looking, from that perspective, and people are looking to cut money, they're going to be shopping at Dollarama, not at Best Buy and London Drugs. So that's when you want to look at, what kind of margins does this company have? How are they going to grow? Will they make 20%? I don't know, but I like Dollarama as a company. We go there a fair bit because we can get certain things that we need for the house.
I like companies that have a psychological hold on their consumer base. So Coca-Cola does a really good job. Everyone drinks it. That's why Warren Buffett invests in it. Google has a psychological hold on me. I'll just use Google products now, even if they might not be better. I'm in their ecosystem. The reason why Dollarama stuck out, I realized it was more, I'll go there because good deals, convenient. I know they have everything. But when I first met my wife a decade ago, one of the weirdest things about her was she had a routine where she'd go to different Dollarama, dollar stores, and she'd just go around, and that was her relaxation. She'd come out like, I mean, she'd go in with 20 bucks, come out with all this stuff. And to this day, she still does that. She'll like go out, she'll go shopping, but she goes to the dollar store.
Yeah,
She's doing well in life, but I'm like, wait a second. And I kept meeting people who are like that. I'm like, wait a second. Dollarama has a built-in customer base, regardless of what they do. They'll always meet a minimum revenue because these people will always show up. Like
that's
the
right.
core group is there. I'm like, okay, well, you have a core built-in audience, core customer base. I'm like, that's a good starting point for them. So that's what got me looking at them. And then there's dipping and all that. I was like, wait a second. So I knew that they'd always be around because my wife wouldn't go anywhere else. If Dollarama closed down, she'd be crushed. When we go to a different city, she'll be like, oh, I wonder if there's a Dollarama nearby or a dollar store. I was like, that's crazy behavior. But it was her and other people are a lot like that. So that's a good indicator when you're looking at something. Do they have a built-in customer base that will ride or die with them, that will be with them no matter what? Then you can kind of guesstimate out revenue for the next 5 years. You go, well, only these people bought. What would they have? If they did nothing different, what would they have?
Absolutely. Which is what takes me back to the railways because there's only two of them. Like you're not going to go wrong by buying either one if you wanted a single stock position. They have a monopoly in Canada, and I think that's kind of what Dollarama is. There's a few other dollar stores, but they don't compare, and Dollarama's been growing fairly quickly.
I think that I kind of noticed a trend with people watching us talk is a lot of the investments we're making, we get some personal connection with personal experience, some internal insight that we only have through a personal experience, like the Dollarama thing, personal insight that I kind of clued into, and that's dictating my investment. Like where I'm looking. That's kind of a good way to start. New investors start there. What I don't ever suggest is going on Reddit, reading through threads, seeing a stock get pumped, and going, I'm going to get excited. That's a great way to lose your money, right?
Yeah, like just from my perspective, like I have my iPad just to my right, so if you ask me something, I might be looking off because I'm typing it in. But uh, that's what I do is I'll read it or watch about it on YouTube, and then I'll start reading about it. What is this company? What is it all about? I'm not going to blindly go buy something, like you said, just because of the hype. I want to know something about it before I do that. I think that's a good place to start. There are plenty of people, maybe like yourself, that have the time to and look into their books and figure out, the minutia, we'll call it, of what that might look like over time. But the average Canadian, you're probably not, you're not going to do that. And these days, that there could be some language barriers too if you're trying to research stuff, which is why investing at Google is good because they have the Google Translate. Um, but yeah, like I want to know the company. I'm not gonna go out on a limb and buy something I don't know. Again, I'll say it again. That's why ETFs are so great. There's plenty of companies in there I know nothing about, but they're in that basket and they create those returns. Oh, that reminds me, sorry, you mentioned something earlier about the growth in the portfolio. So I use passive as on my channel. That's how I show people the sort of what's happening in those accounts. And you mentioned that, your returns are 30+% this year. I think that's the thing that sticks out to me is, I knew nothing 2 years ago and I've grown the portfolio, albeit it's small comparative to some people at my age. But seeing that growth number, I often scratch my head. Like we've been talking about these stocks and ETFs, but I don't have a great deal of knowledge and I'm still getting those kinds of returns. Now, after this, I might go and trim a few things that you have mentioned to me. I may or may not do that. But at the end of the day, those are minuscule compared to the overall diversity of this portfolio that I've built. And again, this is just me doing this, regular Canadian.
And a lot of the reason why I mentioned trimming is because you don't have a lot of time. It's okay, now you have less to pay attention to. So if you, instead of having 17 stocks to track, you have like 8. And then if you were to onboard one more stock, you can just hyper obsess about that one stock with all your free time, really figure it out. Then do what I do, be like, oh, well, that was a waste of time. But then 6 months later, you finally find one where you're like, all right, it hit all my check marks, right? A long list. You have 6 months of allocating income towards that. So you got a larger pot now. And you go, all right, here we go. And then you just can go to bed at night and sleep at night because I'll check back on this in 10 years or 5 years or whatever my time horizon is on this investment.
Yeah, that's very true. And like I said, it's across multiple accounts. Now, I don't necessarily monitor them daily, but I do check in from time to time, just making sure they're not, falling off the side of the mountain, if you will. The one thing I do, though, is if I'm going to sell a single stock position, like it's not performing well, and I have done that a few times, I do start tracking it to make sure that it's up above where I purchased it, because you're talking about larger gains if you're going to hold something for a long period of time, making 20%. If you're a new and you invest in something, the piece of advice I'd give you is, unless you're like losing your shirt like on QQQY, like that one, I sold that at a loss for the stock price. But it's okay. Like, let's say Plaza REIT as an example, that stock price has just been puddling along about $3 to $4. I would just wait till it hits the point at which I had averaged price it when I purchased it, and then I would sell it at that point. And that way I'm not, losing my shirt on something when I didn't need to. But I also know I'm not going to be making 20% on that thing.
Yeah, I've done that a few times, and then I just reallocate that money.
Yeah,
I've done that with them. I'm like, oh, this isn't performing the way I wanted to. I'll wait till it hits that buy-in price I had, and I immediately take that money and I go put it somewhere else where I go, that's a better investment. You're just moving money at that point.
absolutely you are. Yeah.
Yeah. All right. So now we have QQC.TO Invesco Nasdaq 100 Index ETF. That's a good one.
Yeah, so just concentrated version of, I like to look at it as a concentrated version of VFV. So these top 500 companies, we're concentrating that a bit more. It's a smaller percentage. When I looked at the asset allocation, I thought, okay, we're going to build that into, so it essentially equals 50% of the portfolio between VFV or VU. So that'd be the S&P 500. And then when you add the NASDAQ on top of that. So it's just a concentrated version of it. It generally has good returns and grows about the same as VFV does. But with concentration, like we talked about with single stocks, it could take a bigger hit if the market takes a crash. So,
Yep. Next, we have ZSP.TO BMO S&P 500 Index ETF.
yeah, so that's ZSP. That's, excuse me. So on the channel, I talk about teaching my kids. So my kids right now are 10 and 12, and I want them to learn things that obviously I didn't know. So we took my wife's TFSA, excuse me, and we use that as their account, because you really can't open an account for a young kid. There are a few ways to do it, but I don't think it's worth it right now, and we don't need that room. So I wanted to try a different S&P 500 fund in that account to see if it varies much. And quite honestly, there's not a huge difference between them. So that's the only reason you're seeing that, is it's in my kids' sort of fund there, and it was a test to see if it's any different.
Is it any different though? Even if there's small difference at all, like even like a 1% difference or anything?
I don't think so, because the managers of these accounts, they will go rebalance if they think it's not performing. They might take Tesla and make it a bigger part of the portfolio. That's where you're going to see, when you look at those funds, the differences between them is the concentration of each of those stocks.
What's the do you know what the expense ratio is on that? I think I have the wrong stat. It says 0% here for some reason on my stat. Because I feel like that would be the deciding factor for me. Would be, I wonder what their expense ratios are between VFV and ZSP. Because if the expense ratio is cheaper, I'd just be like, oh, let's go with that. Because in the end, that's all it is really. Like, which one is cheaper? VFV is 0.08%, but when I was pulling stats,
is that SP is 0.08%. Sorry, yeah, sorry, it's 0.09%, I guess. So the maximum annual management fee is 0.08, and the management expense ratio is 0.09%.
So yeah, 0.09%. So just 0.01% more technically. So it really, honestly, this just comes down to, hey, I bank with BMO, or I like BMO products, and then you use that. It did really no difference. Yeah. There's a couple here that I have. EIT.un.to. Is that one of yours?
You can thank Adriano for that one. So EIT is a split core fund. Essentially, it's a monthly dividend fund. It produces the same income every month. And again, it was like, well, let's see how this does. It's in the 2 years that I've owned it, it's never really changed. The income has always been the same. Honestly, I don't. At some point, it's that one's sitting in one of the other accounts that we're not doing any with. I think it's in my RRSP, one that I won't be adding anything to, or at least not anywhere in the near future. So it was a bit of a test, and quite honestly, it's income and that's it. I might even get rid of it. I really like HYLD. That's where my focus has been going recently. And if you look at when I tend to follow what Adriano does, he tends to change his positions monthly. It's funny because he says he's a long-term holder, but anyways, he does change the funds up quite a bit. And so that came from him. Again, it just sits there and does the monthly income. That's it.
What about eqcl.un.to? Is that what it is? I couldn't find anything on this. What's that?
EQCL?
Yeah.
So EQCL is another covered call, but it is it's kind of like well, it's a like XEQT only in the covered call world. So what I wanted to see was in my video where I do this covered call case study, I wanted to find one like XEQT or VGRO or whatever that you could just put all your funds in and see if that would perform as well as some of the other covered calls. And there aren't very many of them, and this was the one that I chose. Although someone had suggested there's another one, but that's the one I chose, and that was the reason for it. So that's in my Wealthsimple spousal account. That's very small. It's $6 a day split between HYLD and EQCL. And we're just going to see what that looks like at the end of the year. And, again, talking for your viewers, think about $6 a day. Like, can you skip a Starbucks coffee? Maybe, maybe not. Maybe you shouldn't. But that's the way I look at it, is we're going to see what kind of income we get by the end of the year and how that performs against, say, some of the other funds like VFV.
So to summarize, here's what we went over. We went over XEI, HYLD, YTSL, TD, S. Did we do SVOL?
No, we didn't. So SVOL is also a covered call. It's like it works on the VIX, and I can't really explain the VIX too well. But this fund performs better when things are flat. So it's an monthly income generator. Works off and the VIX is the volatility index of the stock market. So right now, with our friend south of the border, this fund is not going to perform really well. But prior to him getting into office, it had monthly income, and it performed well against that.
So it's basically good to add in your portfolio when things are stable.
Yeah, absolutely. You don't be buying that one right now, and it's in USD as well, so you have to convert your funds somehow to get that one. But yeah, again, I wanted to give it a whirl and see how this would perform against some of the other income funds.
So it's a covered call. Yeah, it's a covered call. That's so weird. It's a covered call that works off of stability, not volatility. So it goes against the grain.
It's exactly how it's described. That's right. Yeah.
Okay.
Maybe I should do a whole video. Actually, you know what? That's a good idea. It'd be a good video because it's very unique, but you have to play it right.
I never heard anyone even talk about that before. Like, hey, I have a covered call that leverages normalcy.
Yeah.
So it's weird. You have HYLD. You had HYLD.U.to. That the one that you actually had? You had the.
I have them both. So I have just some in the American funds and some in the Canadian funds. So because the portfolio is like almost, it's probably better than 50% now. I think I got about 60% in USD and the remainder in Canadian. So I'm just holding it in both currencies is all.
And that's for anyone wondering. If you go to Hamilton, you'll see HYLD.U and HYLD.to. .u just means US currency version, right?
That's correct, yeah.
So VFV.to, REI.UN, pretty sure we talked about that. VRE.to, CNQ, PLZ, EIT, EQCL, ATD, QQC, ZSP. This man has 17 ETFs and stocks. He has a lot of that. He's going to consolidate a little bit of it if it's worth it. If it's not worth it, hold on to them. If they're performing well, might as well.
There's actually a few more if you want to talk about them here.
Sure.
I'll open up my my passive because it's the easiest thing to use. Because I think it's important. It's for where I sit now as far as the strategy goes, and I can talk about the Canadian and the US versions of them because I hold them in both currencies. So my TFSA is like I said, the bread and butter of where I started and my channel and all that. My asset allocation is comprised of 40% VFV.
Mhm.
Then we have a Canadian mix of XIC and XEI, and that sits at 14%. Um, for those that are wondering, and I don't know if you've talked about this in some of your videos, Gary, but having a home country bias and buying all Canadian funds. So, like, let's say we put all our money into XIC in the TSX. Yeah, that's probably not a good idea. We know that there's other funds that will perform, and if the Canadian market takes a dumper, so does your all of your fund. So, I hold two other funds. So I'm looking for international diversification. So we have North America with VFV or VU. We have Canadian exposure with XIC and XEI. Oh, sorry. With the North America, we have QQC as well. But then we have XEF and
Yeah.
XEC, emerging markets and international markets. So after, keep in mind, this came long after I started. So all the stocks you've asked me about, why'd you buy them? Yeah, shotgun approach, new beginner. Let's give it a try. But those different ETFs give me exposure to the rest of the world. And they're not a huge proportion of the portfolio. So XEF is 15% and XEC is 8. But what I've noticed is because I have some of that diversification built in there, when one part of the world is not doing as well, the other may be, and it helps keep the portfolio rolling along. And then to finish that out, I have with the whole portfolio, I have like, I think it's about 15% are in single stock positions. And then like a small mix of, like we said, the REITs and stuff. But those two funds, I hold the XEF and XEC, I hold those in the spousal in the RRSP, and the equivalent of that is IEMG, and then you have AVUV and AVDV. So essentially, they're just the same idea, just in US funds. And again, it gives you that broad international exposure.
So this looks pretty good. What's your percentage for QQC?
QQC, I have QQC at 5%, and that's to match. So that gives me in the TFSA anyway, 45% for North American exposure.
That's good. So that's 45%. Technically, that's S&P 500. I know QQC's, but that's a really good. So what I would tell people typically, if I go, hey, you're going to set up your TFSA, I'd say VFV, I would say XIC, XCI, QQC, XEF, and XEC. You have that, you're done. And then your allocations probably have more in emerging markets than and international than I would do. You have 15 and 18%, right? So you have 20 something percent.
No, sorry, 15% in XEF and 8 in XEC.
But that's 20 something total
Yeah.
between the two. I kind of bundled them together.
Oh,
Yeah. And then Canada, you have 14%.
I actually think my Canadian exposure is a little higher than I probably should have it, and that's only
Yeah.
because of XEI. So initially it was
Yeah.
like, oh, like
Oh,
this is
okay. Canada, I probably at like 10%. I have it. What's my suggestion? I always forget. It's like 10% Canada, 5% in XEF, 5% in XCC. So you have 20% there. And then I go hard on VFV. I go 80%. If you're gonna, or and then that 80% is VFV or QQC, however you want to allocate that. But my portfolio is a little bit different. I have a ton in, like, I think I'm at this moment talking, I'm like 25% VFV, my overall portfolio, probably like 60% single stocks or something like that. But it's over years and years and stuff like that. But yeah,
Yeah, and I'm certainly not here to discourage folks from looking at doing the research and buying the stocks you want to buy. If you have the time and you want to learn that, that's one of the things I set as a goal for this year. Uh, I think what I'm going to do is probably do a video where I look at maybe EQ Bank, something that I want to buy, and look at the books and figure out, would this be a good investment and why, from my perspective as a beginner. But that's just one stock of so many you could buy. Again,
yeah.
full-time job, dad like you, I just don't have the time for it.
I'm 100% want to discourage people. I want to discourage them really badly to buying single stocks because I feel like that is the pathway to never making money in investing. I do it because this is like what I do all day. I'm like entrenched in this space, either like just in every way possible. So I do have the time. I do spend my free time doing this. So, and I've been doing it forever. So like that's why I do it. But Jesus, if someone is a new investor or even someone who spends a few hours a week investing, don't like. I'm what's the thing? Like, even if you're good at it, you're probably still not going to beat the S&P 500, right? Like I still don't like I'm a weirdo who's obsessed and do some crazy stuff where I'm sure it could backfire on me at some point, right? But and that's why I'm able to kind of beat those returns. But like I said, like I have a day built around this. It's a whole different mind. I'm living in a different world. And if you're an investor and you got real money or a little bit of money, it's what you outlined.
I think
I
that,
literally would just follow you what you're doing
well,
here.
and the irony is like you're kind of hitting on what the average Canadian should be doing. So
Yeah.
pick a broker. So first of all, get rid of your debt. And there's a whole conversation around debt. Some would argue what's good and bad, but you want to eliminate that stuff first. Don't start investing till you do that. You need to pick a broker, right? That's step number two. And there's a variety of them. You know, the ones that I use, they might not work for you, but do your research, but pick a broker. For me, it's well simple. And the only reason is it's very easy to use. I can whip my phone out, and it's all because they're a financial institution. They'll offer a lot of other products as well. So for me, it's been really easy to use them. So at a recent work event that I went to, someone in the group, we just got talking about this kind of stuff, and they were intrigued. And the next thing you knew, he was asking me, like, how do I do this? And within 10 minutes, we had their setup and money in their account and made their investments because it's that easy. And you don't need a lot of money to do it. And so what you said is that your day is built around this stuff. You can do that. You can build your day around assessing companies. But if I was starting out, plain and simple, I agree that it would probably be VFE to start with because your money's going to start working right away. And you're probably not old like me. Well, maybe I'm not as old as I think, but that's how simple and easy this can be. It's not scary. It's not. I think a lot of people think that like, oh, I don't know what to do. Both Gary and I can have you set up in the next 10 minutes, starting your investing journey right now.
And if you use a simple strategy, you might slightly underperform a financial advisor or something, someone who does this all day. Like you're talking about like a 1% difference. In the end, let's say you start in your 20s and 30s and you just use a 3 ETF portfolio, like one of the basic ones with VFV leading the headway. Do you care if you have 1 point something million versus 1 point something slightly more million? You do not care. And you never thought about it. And I've had one of my friends, he's just like, I just have XEQT in my TFSA. Perfect. Like I actually think, I'd run out of content. I'd have a one video channel and it would just be me being like, all right, you want to start investing? Yeah. Get rid of debt, find a brokerage, buy XEQT, backset your TFSA every year with it, and check back in 30 years.
Yep.
Oh, okay. That's it. That's the investment.
I mean, the all-in-one strategy does work. I do hold that in one of the accounts. Again, it's just to test to see how that performs against other things. It's easy. Set it and forget it, right? I talk about it in some of my videos. But I think like most people, once you get started doing this, you're going to have some questions like, how do I invest in something else or a single stock? There's so much to learn.
I think XEQT is the best for someone who never wants to think about it. It does become a thing where like, wait a second, I can actually get even more money because you realize how easy it was. Then you go, okay, now I'll scale up to a 3 ETF portfolio. Maybe I'll make it 5 ETFs. But then still, if you're a casual investor, someone who's not doing this full time, don't really go outside the realm of ETFs unless you have some deep internal knowledge about that stock and you've been doing it for a few years.
Yeah.
I feel like that's the safest way to go about it.
100%. I mean, the asset allocation that I have is essentially a breakup of XEQT. I have a few more things, but if you were to look at and that's also important for people, it's easy. You could type in XEQT into your Google search. You'll look at the ETF and they'll show you the breakdown of what's in there. Those are some basic things that you can do. Anybody can do it from their phone or their laptop. And then you can compare that against what other funds may exist. You could search like, well, what is an equivalent to VFV? And then like we talked about before, that gets down to the minutia of, well, how much is the MER on this? How is the performance over time? Those are some basic things that anybody can do. You don't need any special training or equipment to do that.
Let's talk about your transition period now. You're 8 years out, so you're right at the beginning of it. This is like, I guess, 10 years out, you start thinking about it. 5 years, you really start scaling it up. What's that look like for you on your end? What's your strategy, bro?
So I think it's definitely going to start focusing on developing some income, that laddered approach of how we're going to withdraw that money. But here's the thing for me, and there'll be other people out there like me. You may have some sort of pension or other income that you're going to rely on. So I might not actually have to touch this money till quite a bit later in life. So we could just leave it growing. But assuming that we would have to start drawing down on it, then I think we want to start looking at some laddered approach. So how much are we going to withdraw? Some of you may have heard the 4% rule, maybe some variation of that. That's not a hard and fast rule, I would say. You need to figure out how much you're going to need to live on every year after you retire. And then how do you make that money generate income for you real time? Well, monthly income is where it's going to come from, whether it's the covered calls or some other fund like the REITs I was talking about that produce monthly income. And then I do need to think a little bit more about some fixed income. That comes from the emergency fund, right? You always want to have an emergency fund, which is part of the three things you want to get out of the way in the beginning, because you never know when something's going to come along and you need a bunch of money for. So that could be something. And you mentioned it earlier. I've been thinking about this a lot. They talk about having that emergency fund sitting around waiting, and maybe you put it into a GIC where it's earning a fixed amount of income. On the other hand, some of these covered calls like HYLD that have no real NAV erosion and generate income, that might be the place to put that, because I could sell that unless it's, down that day, which is the only risk that you take. But you could eventually making money on your emergency fund and then sell it off and take it out if you needed to. So that's sort of the idea is we need to look at generating some of that income into retirement in certain funds. And I think that's where my focus of learning about covered calls will be.
What do you suggest people have set aside for their emergency fund? What percentage of their year, like how much of their expenses do they need set aside? Because I go by expenses, like what's your monthly expense?
Yep.
Have 3 months of that set aside. I say try to aim for 6.
Yep.
Try to go over a year if you can. Just be a crazy person to make it as long as possible so you never have to worry.
Yeah, so what I've been teaching the kids and my methodology is the 20, 30, 50% rule. So 20% of your income is going to be for your investments, 30% will go into some sort of savings, and 50% to your general revenues. Now, that's going to be based on how much money you spend every single month. That 30% is where that emergency fund will sit. And I like to say it's somewhere in the 3 to 6 months of money that you would need. But realistically, it'd be 6 months. I don't think you want to don't do on the bottom end of that. Because if you check my last video out that I just posted yesterday, we had a conundrum that hit us. I thought I was prepared. And as it turns out, sometimes there's things that come up. And so you have to prepare for some of those other fees in other ways. And I talk about it in that video. So 3 to 6 months, it's about, in that, I think it's probably like a 30% goes to those sorts of things. And then, like I said, now the discussion will be, what do we do with that money? Do you want it all available, some invested? Remains to be seen.
I'll talk a little bit about my finances. Let's get your thoughts on this. So I have that 100K that I had emergency fund that I'm just doing covered call tests on now and whatever, trying to siphon money out of that thing. But I'm reinvesting every dollar into it. So it's just, I've now thought, why don't I just turn that into like something that generates $10,000 a month? Why don't I take this more seriously rather than, and I'll actually turn this into a non-registered account thing that gets taxed heavily. That's cool, right? My growth strategies for my RRSP corporate account and my TFSA. That's where everything is. But now I got this other thing because why can't I have some money now if I want it? Why can't I start getting some? Why because I don't want to technically I want to work by choice after 45. Why not, if I feel like it, take money out of that thing I built up in my non-registered and just, I'm already paying taxes on it now, even if you don't use that money, and like live off of that, build that up to a 10K a month at least or something like that. That just pays me out every month if I want to, but I'll probably keep investing back into it and keep building that up.
Yeah, so that's kind of what I've been thinking about is if these cover call strategies continue to, there's lots of them now. It does seem somewhat reasonable. The question I would ask myself is, okay, if I stick it in a GIC and I make, I don't know, what are they earning these days, like 5% or something? And it depends if it's locked in or not. But with this type of fund, a covered call strategy, will just be generic about it. You can do a calculation based on how much it returns on average. So you will know how much monthly it'll generate, and then figure out how much money you need to put in to do that. And maybe that's your emergency fund, which you then can still draw on if you sell it. So it's not necessarily a bad thing. But like most people, unlike you, sitting on my side, imagine me 2 years ago, if you'd told me that, I probably would have just, chewed on my nails and thought, oh man, I don't know. Can I do that? It takes some time and comfort to know that when you put your money into these funds, that no one's running away with it. You're not going to lose your money. I mean, that can happen. So don't fool yourself, but it's not a bad strategy. And it's something before we started talking today that I got thinking seriously about. I'm like, because what happened to us is that our emergency fund got wiped out due to the bill that we got, and now we have to build it back up. But and one of the strategies that I'm using, so I talked about converting money into Norbert's Gambit. When I'm putting money into the account, it's going in CAD, and it costs money to convert it. So it's better to do it over $1,000. That's kind of the break even mark. So I've been, aiming for that $2,000 mark. But if I just leave it sitting in the account in cash, it's not doing anything. But in one of those funds, it would be. So I started doing that this month. When I do my monthly update, that's what I'm going to talk about. Is we're going to see, because it will be generating some income, and then I can sell those shares and then convert that cash to US. So yeah, it seems like a real strategy.
I want to explain a little bit further to people how I'm doing this, because I don't want people to think I'm just some crazy guy who just moves money around like it's nothing. Because that's not what's happening. I have a huge fear of having financial stress, right? I've had, like when I talked a little bit about this, but when I was younger, I got really sick. I fell into debt because I was sick. And then I had to get myself out of it and then build up to where I am today, right? So I kind of know what it feels like when you have a credit card bill up there and you're really unhealthy too. So you're like unable to even pay it. It's like being completely screwed. So I have this internal fear. So when I say to people like, hey, I'm going to possibly transition 100K emergency fund into an actual revenue generator, that means I'm preparing to make a mental shift from this no longer being an emergency fund. And what am I doing then? I'm now creating a emergency fund on top of my emergency fund. So now slowly this last month, I've been actually pivoting more and more excess cash into a high interest saving GIC, building that back up now from scratch. So as I put more resource into this covered call strategy in a non-registered, if that does drop a 20%, let's say there's a market, something crazy happens, it is wipes. I don't care anymore because I have that emergency fund. I just lost money and okay, but if something happens, I have that same emergency fund again, right back. I have 6 months, a year built up. So in tangent to this, as I'm getting more aggressive with covered call, I'm rebuilding up another emergency fund. In tangent, I'm still building up all my growth funds. I started with growth. I started with emergency fund, did growth, then went into covered calls. When I took covered calls more seriously, started building up emergency fund even more. I started using that to funnel cash. Like I've never been at a point where I was over leveraged, is what I'm saying.
Yeah.
I've never been at a point where I move too fast in one area where I get screwed. It's like there's no house of cards here. It's a house made out of concrete and brick and steel, right? Is what I'm trying to say.
I think that's the real foundation of investing is like I said, there's three important things, but having that emergency fund, I can't believe that we went to the age we did without really thinking about it. And, having liquid cash is important. You never know when something's going to change. And like you said, while I say there's nothing guaranteed in the stock market. So if your fund takes a, drop, you're going to unrealized all of a sudden becomes realized. So you definitely need to be careful. You're basically saying you're splitting things, right? Initially it was I got 100K, but now I'm splitting it. I want it to earn a little bit of income, but I could still use it if I needed to. But that comes down to your risk tolerance. That's something that everybody needs to think about. Most of us are probably sitting watching this. There'll be a part of your audience that are into this and they get it, and there'll be a part of your audience that'll be brand new, like I was 2 years ago, going, "Oh, this sounds kind of scary." That's the key. Figure out what kind of risk tolerance you have. Start small. And that will help change it. I can assure you, I'm a pretty modest guy. I don't take huge risks. But if you look at where I got to today, it's only because as I learned more and became more comfortable, my risk tolerance changed. oh, I can take on a little bit more here as long as it's
Definitely.
balanced, a balanced approach. So, yeah, I think measuring your risk tolerance is super key.
I started with a $500 investment years ago and I was so stressed out about it. I couldn't sleep. And it was just like panic in me. And that lasted, it took years and years and years for me to get comfortable spending thousands and stuff like that. Now it's become ridiculous, but that's after years and years and years. And I don't even see money investing now as I'm losing money, I'm gambling. It's investments. It's like,
Exactly.
oh, it's like because I know I'm making money off of it, I never feel, I guess I feel more pain when I go to McDonald's with my kids. You know what I mean? Like genuinely, like when I spent $30 on to feed my wife, the two kids, and like a Happy Meal and stuff, I'm going, that hurts because that just disappeared into the ether and I overpaid. Where if I buy VOO, I'm like, oh, okay, it's like still there. It's not going to depreciate. I could sell it whenever I want. I can get it back, but it's going to make more. It's like, it's
So
just
I can
all
totally
good.
relate to that, and it's also an interesting point in the sense that the way people look at money before they start investing will be completely different, and you're hitting the nail on the head. I do the exact same thing now, and I think we were pretty thrifty before we started investing, but now, like, let's say we go out, my wife and I want to go out for a nice dinner, and we get the bill. You know, these days that bill can be 150 to $200, and then you say to yourself, what value did I get out of that? And your
Right.
example of McDonald's is similar in that because, you know, inflation goes up, prices change. But I really think about that now. I'm like, if I had invested that money in anything else in our portfolio, that money would grow. So you have to really think. Now, what I will say is when you invest, you don't want to do it so you're miserable. Okay. You need to have a relationship with your money too. Uh, you want to enjoy it for what it's worth. So if you're getting value out of something, I'll use an example. Let's say you want to go to Turks and Caicos, okay? Beautiful place to go, nice white beaches, very expensive. But if that makes you feel better, that's not a bad thing, okay? It might mean you have to shave a few Starbucks coffees back home before you go. But when it comes to your investing, you want that philosophy to work on the regular side of your life. So don't cut those trips out. Figure out how to balance your money, keep yourself happy so that you're not eating craft dinner now so that you can eat craft dinner when you retire. That doesn't make any sense.
Let's dissect that a bit because that's really important. I think a lot of people might fall into that trap of I have to suffer now so I have money to invest, and they forget that they're existing right now and they're living a life, and you still don't really know how much time you have. You might as well enjoy what you have, and so I guess it's finding out, okay, what do you have value on, right? What do you value in life? Spending money on those things, then being an adult about it, and then really learning how to allocate. So if you are someone who loves to travel, like, okay, how much does it cost me to travel? Okay, great. I'm just going to travel, but I'm going to spend less on clothing because I'm
Yeah.
not a clothing guy, right? And then you can make up the difference, but you still have to hit those minimums with your investing because you know that's part of your job, right?
Yep.
And you can travel. At least I'm going to, for myself, I would travel more at peace of mind knowing that I could travel for the next 20 years and not be broke when I'm done. I can
Exactly.
continue to travel, right? That's sort of how it adds up. There's a guy, Rami, something, some brown guy. I can say,
Ramit Ramit
yeah,
Sethi.
yeah, I can say brown guy because he's Indian, I'm pretty sure. But yeah, so but like I'm on his email list, and that's like the one message I think he had. That's
That's
like
his
his whole
big
thing, right?
message. Yeah.
Yeah, he doesn't deviate. He's very good at like niche focus, and he's good at that, right? I think people should check out Ramit Sethi.
Ramit Sethi. Yep. If you have Spotify, type it in. I've
Yeah.
listened to it, and that's where I get that message. I talk about it in some of my posts and on the channel, because yeah, don't be miserable. And I like your analogy. Like the things that I don't value, my wife might. She might like clothes. Maybe I don't. So I'll spend less on clothes. She spends more on clothes, and we get that trip, and we're still happy.
Let's walk through. Let's give some people some case studies. Let's get people to know us a bit. I want people because it's weird. So you're watching me on camera, and I talk about finances, so people go like, okay, this guy clearly knows what he's doing. He probably is financially well off. But if you were to meet me in day to day life, I dress like this, I look like this, but I'm always just wearing a cardigan. I don't comb my hair. I'm very unshaven. I drive a Toyota RAV4, right? I live humbly. I just like I've owned a home and all that stuff. Like I'm happy. My kids are just kind of wearing whatever people gift them and whatever we buy on sale. My wife likes to go to the dollar store. You would just think we were regular middle class, regular people because me and my wife happen to be highly frugal,
Yeah.
just in general, and it pains us to spend money unnecessarily. but our bank accounts may not reflect that. But then what do we value? We do like going out and eating a nice sushi dinner.
Yeah.
We have a couple of nice trips planned. We're not maybe staying at 5-star hotels, but we know I'm definitely not worrying about money. But our main thing that me and my wife have in common is that our biggest happiness is never worrying about money
Yeah.
and never thinking about money. Literally being able to purchase whatever we want whenever we want, choosing not to because we don't care to, and never thinking about it.
Yeah.
And that's the main driver. I think that's our happy spot. What for you is that? Like, what are your things and how do you manage your day? What are your things that you go, I spend on this, I do on this, and
Yeah, it's exactly the same thing. I use the Turks and Caicos example. We've been there twice now to a very expensive resort, but we don't do it very often. We get value out of that. But if you see me driving the truck I have, it's, 2018. It's not new. The last truck I had drove into the ground until they had to tow it away. And that's not to say that, I want to drive a piece of junk, but I don't see putting money into certain things as I don't need that. I need the truck to be able to pull our trailer. Yes, we have a trailer. We glamp. Those are the things that give me happiness. So my dad and my son and I, we went camping on the May long weekend, and it was absolutely the best time. It snowed, it rained, it was terrible weather, but I thoroughly enjoyed that time. But we had to buy a trailer and a truck to do it because I value that. But we go and shop at Once Upon a Child, which is basically a play it again type clothing place because even we're trying to buy bikes for the kids right now because they're growing so quickly. We don't need to buy them new. We can buy them off of Marketplace. It's just about making choices. That's how, like, the examples I give, if you watch my channel, I actually do a video on it. We have clippers at home. My son and I get our hair cut at home because it's cheaper, and we have control over it. I don't pay for parking at work. I park and then walk to the office. I take my lunch to work. It's leftovers from the day before. If you think about like lunch itself, and again, if you value eating at Starbucks every day, I use that a lot. I'm not bashing Starbucks here, but let's say you love eating lunch at Starbucks every day. Okay, great. That you should do that. Don't stop doing it. For me, I could care less. I bring a sandwich or a soup or leftovers, and then that's where some of those savings come so we can go take those trips or go camping and all those other things. So it's very similar. If you like, I shop at Costco a lot. I'm sure there's a lot of Canadians that do that. So if you see my wardrobe, you probably think I was just at Costco. I don't care. Like I'm wearing a nice shirt today. This is one of my work shirts, like you were describing. If I take you in my closet, you're going to see a lot of Costco t-shirts because that's just how I roll. It's not important to me to have a Gucci bag and all that other stuff. It may be for somebody else, but for me, it's not. So it's making those choices will help you grow your net worth. And net worth just isn't about your money. It's about everything about you.
I love that. And so like we're basically saying is find what you love. Like I said, I drive a Toyota RAV4. If I was a car guy, you don't think I was talking about one of my friends off camera, and he's a car guy, and he's fairly frugal in other areas, but he has a wicked like 1970 something Corvette. He threw down all that.
Yeah.
But it's like I would do the same if I was a car guy. Like I would find a way to
Yeah.
allocate money. I might be a car guy with only t-shirt and jeans, and I might be only eating macaroni dinners, but god damn it, I'm eating that dinner in my Corvette. Like I'm doing that, and then I'm also investing every single month and doing that at the same time.
And I think for me, that's again, I know I've been mentioning my channel a lot, and I don't want your viewers to think that I'm just so engorged in this idea, but you just said something that resonates so much with me, which is if my kids, I'm hoping that they continue this idea that I'm teaching them because nobody taught me this stuff in school. I wish they had, but they didn't. If I had even started investing when I was 18 years old, a small amount compared to what I have now, our net worth would be completely different. And that just baffles me that I didn't know that. And again, because of social media, places like Blossom and all these other places, and even when I discuss it now at work, I have some knowledge and people like, oh, you understand this a little bit? We should ask you more questions, which I like, but that then shares with other people and all of a sudden they want to do it. So I think there is some momentum to this, and that's what my channel is about. I'm documenting my journey, having conversations with people like yourself. Mo has interviewed me on his channel as well. a very open conversation where he asks me some questions of the same. I want people to hear this sort of regular Canadian sharing his story so that you can start earlier and grow your net worth.
That's a crazy thing. I always use the McDonald's analogy is when I clued in, I realized I could have done nothing and just worked at McDonald's my whole life. I worked at McDonald's when I was 16. I could have just kept that job and kept investing in my TFSA, S&P 500 VOO or VFV. And at this age, 39, would have been a millionaire.
Yep.
I've done all this work and effort building all this stuff. I could have just kept working my McDonald's job, kept investing in the VOO, and I would have been fine, or the equivalent of whatever that was back then. And I would have been a millionaire. And that's how important you have to teach your kids. I have young kids as well. And that's my whole thing. Make them financially literate by the time they're 18. But I think there's a couple of things there. I talked to Marcos Mila. He's one of the top guys, especially in the US when it comes to ETF investing. He's this hyper smart young guy. Knows everything about ETFs. Check out his channel if you haven't checked it out. And he's younger. So I was like, hey, like maybe I'm being optimistic. Like, are all young guys like you? Like, I'm thinking they're all like you, right? Like, just these super ambitious, kind, nice guys who he's so financially literate, but in the best way. He's not a crazy money hungry guy. He just knows, like, hey, he works hard, he puts some aside, buys his ETFs, and he just knows, like, yeah, good, I'll be good in retirement. I'm like, that's perfect. First off, I wish I thought like that at his age. Like, God damn it. I wish, like, I had no one. But he mentioned to me, he said his dad sure showed him the way. Didn't even hit him over the head with it. All his dad said was, yeah, just invest into the S&P 500. Simple. Like, didn't even give a crash course. And he told him to be financially responsible by not taking on credit card debt and unnecessary.
Oh, yes.
Boom, boom. And that's all it took. And then his dad led by example, which is what you're doing.
Yeah.
And like, what do you need more than that? And that's what happens. You produce a Marcos when you are a parent, and you just tell your kid, you lead by example, number one. That's the only way to do it. And then you just go, don't understand how credit cards work. Don't get debt. Invest in the S&P 500. In Canada, TFSA. If you're American, Roth IRA. It's like, and that's what happens. You get those kind of kids.
That was me, man. I remember when I graduated from post-secondary, got my first job, and what did I get? A credit card? And another guy had a motorcycle, and I was like, oh, that's pretty cool. I want to be in the cool crowd. And I literally walked into the Honda shop and was like, I want that bike, and dropped all kinds of money. Now, go forward, I was paying interest on it. I didn't understand how much that would look like. Credit card got bigger. I went through all of that. Now, there's nothing wrong with learning those lessons, but if you can learn from other folks about that, don't make rash decisions. Plan things out. You can always plan ahead. If I want to buy something, you don't have to do it today. Start putting some money aside to do those things later. I definitely fell into that trap and learned the hard way, and I paid a fair bit of interest. Don't want to do that.
There's a psychological part there, though. There is because we're telling people, hey, just pick a couple things you care about, that you truly internally care about, that make you happy. But then there's the keeping up with the Joneses, you caring about what other people think about you. You've been alive long enough. I've been alive long enough. We know who gives a shit what other people think, really. Like, who cares, right? Like, if you're not hurting someone, you're not malicious, you're not a bad human being, you shouldn't put too much stock into how people perceive you. What you wear, what you're driving, it doesn't affect anything. You really should only really care about, are you hurting someone else? Are you affecting them in a bad way? And then it's like, oh, wait a second, then check yourself. Like, if you're a drain of some sort, that's more of a character flaw, right?
It
But
is.
an external, if it's an optics thing of car, house, even in the manner in which you talk, I'm not very refined in how I speak, but I'm hopefully not saying anything horrible, right? That's what I really I try to monitor. It's how do you stop that? Because that causes overspending. There's social media now, younger generation. Back to Marcos, I'm like, so are they like you? To no, the kids are watching social media. They feel like they need to have a certain lifestyle. They need to. There's this thing with these 20-year-old girls nowadays who look like they're 40 because they're injecting themselves with everything.
Yeah.
Right. Because they feel this pressure. And then you have people in my category where other parents come to school. Someone's coming with a Hummer and someone look at this and who throws the biggest birthday party. And it's like, how do you not let that affect you? Now, like I said, maybe I just don't give a shit. It doesn't bother me. I could care less. But I know for the majority of people, they're going to feel it, right? And then they're going to feel impulsively, they're going to spend more money on shit they don't care about. And they know they don't care about. What do you say to them? How do you get them to do that mental hurdle of just accepting it and be like, who cares? Because it bothers my wife sometimes. I'll be honest. She'd be like, I'm so tired of like, you really don't try. Like try a little bit, right? I'm like, why does it matter? Like my whole thing is, I don't care. Why does it matter? What anyone thinks? Like I'm cool.
I
Like,
think I
what do you think?
think that there's a deeper thing going on there. If somebody has to go buy a pair of $200 jeans. Now, I'm not saying I didn't do that, by the way.
Yeah, we
Been there,
all do.
done that. But
Yes.
if you need to buy the right handbag and jeans and drive fancy cars because you feel that it will make you have you be perceived differently, there's a deeper issue there. But that deeper issue, when solved, will maybe help sort out some of these financial woes because you're right, they are very much tied. You continually will do something, dopamine release and all that. So, yeah, I it's taken me a long time to get to this frugal stage of wearing Costco clothes and things like that. When you're young and you graduate from high school, you're an adult. You have all this freedom to make decisions. But with that comes understanding how that will impact you down the road. That's the thing that we don't teach people. And so I'm glad that I'm telling my kids this stuff now. Like when we go to Once Upon a Child, that's like Walmart to them. They don't know the
Yeah.
difference. When I was that age, if we went to the Salvation Army, that was a big deal. Like, oh, like we can't afford to go to, back then I think it was Wolco, but
Yeah. Well,
you had to go to, that places because you couldn't afford anything. Well, we now know that if my 5-year-old has a bike and next year he outgrows it, that bike is valuable to somebody else and we're just going to find a new one. There's nothing wrong with making those types of decisions. And to be honest, if you never told anybody, nobody's going to know. They'll look at the bike and go, nice bike. But if you tell somebody, well, I say there's some deeper issues there.
there is. I think you just got to be, because the reason why I'm bringing it up is because I've spoken to a lot of people, just through the channel, getting emails and whatnot, and a lot of people have debt. And when I always see a root cause of they're they're doing impulsive spending, and they're buying things where it's very clear they're buying it for social validation.
Yes.
It's not hitting that benchmark that we talked about as, oh, does it make you happy? Like I said, if you like $200 jeans, I think you should figure out a way to buy those
Sure.
jeans because you deserve it, and
Yeah.
just do it responsibly. If you like cars, buy it. If you like trips, I think you should have Starbucks every single day, because if you like it and it makes you relax, I think it's totally good because it make you happy. But if it's for a validation, but it's causing debt. It's causing debt in 20-year-olds, 30-year-olds, 40-year-olds. It's causing debt when someone is leasing a car for $700 a month, when they're also renting for 1,500, 2 grand a month, or even more. And then they also have credit card debt on top of that. What are you talking? Why are they even watching my investment channel? You can't invest anything. You have nothing to
You
invest,
have
right?
nothing. That's right. You have nothing to invest.
So, so I think people who are in debt, and I'm gonna keep hammering this home, is take a second, be honest with yourself. If you're in debt, are you buying things for social validation, for validation, and really reduce it to what do you internally care about? And that's like work you got to do on yourself that I obviously can't help with, but just start that process, because you solve that problem, you'll stop buying shit you don't need. You'll only buy things you like. You'll be happier for it. And I always go back to, like, I go back to my wife. She goes like, okay, you did something or you said something. And I go, well, in the end, does it matter? Like if this person does not like me, or they like, I'm like, does it affect your day-to-day life? I'm like, does this affect our life right now? Did they somehow affect our bank account? Are our kids less happy? Am I unable to do this thing because this one person thinks a specific way about me now? It's always no. I go, so why am I supposed to care? And it's a
Yeah.
blunt way of looking, but it's a truth of the fact. It's like
No.
if someone perceives you a certain way, how does this affect? Unless they had some control over your income, or they had some sort of control of, like, they can do something physically, or like something they can affect life, but most people can't. They just think something now, and it's impossible to get people to think. If someone's going to think highly negative of you, and then you want them to think positive of you, they're going to think something negative of you regardless, anyways. Even when you do, like, it's like that person alone is going to do. So don't seek that validation.
Yeah, that's so true. You need to look internally and find, value in what you do. If you're not, like the fire movement is a good example where
Yeah.
people solely follow this uh, ideology or notion that I will retire at this age and I will make my life completely miserable to do it to get to that point. I'd say that's probably not a healthy way to look at things. Now, I'm not saying all the people on fire are doing that, but I've seen that. And so, like for me, I want to be a good dad and a good husband at home. I want to enjoy our time as a family. That's key number one right there. The second thing is that when I go to work, do I provide some value to the people that I work with? Because I know what it was like when I started working and how I got treated. And, I want them to have a positive outlook no matter when things are good or bad. And being a parent, interestingly, like it really provides a lot of perspective thinking about how we were dealt with by our parents and what we learned from those things. So, yeah, I have a great deal of respect for people that are willing to look internally and figure out how can they offer something now if I'm supporting them. Because at this point in my career, I'm the one that's supporting them, like guiding and mentoring and stuff like that. So, yeah, you really got to reflect. Be happy with what you do. If you don't like it, probably should find something else. And it might not be making the same amount of money you're making, but you pointed out you could still be working at McDonald's and do this stuff that we're talking about. Small amounts of money grow over time.
If you don't like what you're doing, transition to something else. I know we're all over the place, guys, but who cares? Just I got chapters below. That's why I said at the beginning, just flip around with the chapters below. I like it when people follow their passions. I don't like it when they do it without without a plan or some level of strategy. If I go, hey, I'm gonna leave $100,000 a year and I'm just gonna go become a hippie, and then you're suddenly in debt and your life is screwed. It's like, be calculated, be smart, have a transition plan, have some sort of like work, like a frame in place that you can follow, an execution plan, like do all of that and then go do it, like crush it. And then when you decide to do that other thing, become the best at whatever that other thing is. Don't settle for like second place. Try to just be the best at whatever that is. But I just think there's a lot of people out there who go, you've seen this on YouTube. If you're unhappy with what you do, quit your job and follow your passions. Like you just screwed over a lot of people who might be listening to you, person with 1 million subscribers who's making a lot of money, and easier said than done. It's like that person has 2 kids. That person has a lot of stuff. They should probably think of, if I'm going to do this, do I have a year of runway income? Do I have an execution plan? If I'm starting a business, do I have sort of clients lined up? Like
Yeah.
do that first. Have a lot of sleepless nights setting that up. Especially if you have kids, you're working during the day, you have kids in the evening. Maybe you're working until 1 o'clock in the morning, getting all that dialed in for the next year straight. Sacrifice, get that happen, but do that. So when you do pull the trigger, you're not completely screwed. Because I can't imagine anything more stressful than shifting careers or changing direction in life when you're then scrapped for cash.
Yeah,
That
no,
was
it's so true. I went through that. I've had this, I'm in my second career now. My first career, I had to take a leave of absence from the first job to move to the second one. But I financially set myself up and I had a plan on how to make that transition. So I can definitely relate to that. You need a plan. You can't just
yeah.
pull the trigger on it and, like you say, be a hippie tomorrow. Then you'll probably be more miserable than you were.
People make that content because it gets clicks, by the way. Whenever you see sensationalized stuff on YouTube, I have a marketing background. Please don't believe it. If something like, we're talking, we're going like, hey, do this. And then there's a lot of bad included as well. Like, hey, you could just go wrong. Then, they're probably telling you the truth. When someone gives you 2 sides, when they show you both sides of the coin, then you're getting truth. If it's all good, there's something weird happening and you're probably got clickbaited and they're probably trying to sell you something. Let's talk a
Yeah.
little bit more. Let's talk a little bit more about sort of when you're transitioning, you're gonna be transitioning more into income based, but you'll have some growth in there because you still might pull from it. What are you looking for as far as like a benchmark monthly yield, like a monthly
Like
number?
as far as
How much
income goes.
every month? What would you like ideally in retirement?
So the what I want the portfolio to produce is $20,000, whether it's from the growth and just selling off or from income every month. I can pretty much guarantee it's going to be more than that, but
Yeah.
like we say, you can't bet on that, and that's to supplement my pension. So I chose annual salary with the calculator I used, knowing what my income from my pension will be, and then supplementing that. So I wanted to produce about $20,000, and I'm pretty confident that that will definitely be the case. Which when I started, didn't have a clue. I didn't even think we'd reach the goal I set, which is clearly not the case.
Who are a couple people you've been using for sort of like YouTube research? You mentioned Adriano, he's a good one. Any other kind of guys who stick out in your head that you think are pretty good resources for anyone watching?
Yes,
Other than yourself, of course. Other than
well,
yourself.
and I think I'm a pretty modest person on camera. By the way, the YouTube journey is something else. For those of you that are wondering, this is the second interview I've done, and I find that this type of conversation, you're seeing the real me. Some of my videos, they're scripted, in the sense that I want to deliver the right content, so I script them. But being on camera is tough, and you're putting yourself out there. But it also helps reinforce the ideas that I'm learning, and that's why I like doing it. So I'm certainly no expert. I know that there are people that are following that are some regular. There's one person, Vic Gill. He's been following me right from the get-go. He pretty much comments on all my videos. I know he's out in BC here as well.
Hey, Vic.
Yeah. And I like that. I appreciate that. That's how communities are growing. And that's what I like to refer to it as. It's a community. So if we back up, that's what I love about Blossom is it's a community. You know, you can learn a lot of good things and a lot of bad things, because there's a lot of people in there that are sharing info that could be rather confusing, and yet there's others that don't. So I actually have a list of people that I have been keeping. You just have to bear with me here.
No worries.
You
You
have
have a list of people
Here we
who
go.
have been
So
commenting on your videos and stuff?
no, these are the YouTube folks that most commonly that I like to or when I started too. So I'll just list them off. You can edit this if you want, but
No.
so Canadian in a T-shirt is probably one of the most popular folks on YouTube and on Blossom. He's also a shareholder in the company, I believe. He is grassroots, and I think that's why people like him. I believe he's also an immigrant to Canada. I could be wrong about that, but those things resonate with a lot of people. Like I just noticed a post this morning where someone said on Blossom, like, I want to invest, but I'm not staying in Canada. Well, that's kind of unique. Like, how do you approach that, right? So, Canadian in a T-shirt, the Canadian dividend investor, financial nirvana mama, Brandon Beavis. He's one of the people behind Blossom. He and his dad both have channels. His dad's channel is very focused on newsworthy stuff when it comes to the markets. Robin Haney. For those of you who are looking for another person that's grassroots like me, Robin is definitely that guy, and he has a huge following. And he talks about he worked at Loblaws, so this notion that you could work at McDonald's, embodies that. And you know, he's built a $220,000 portfolio in, I think it's probably 4 or 5 years now. Grassroots guy, and he shows you same stuff that I do. That's actually where I got Alaman Couche-Tard came from him. Actually, was he has that holds that. So passive income investor, FinTrack Freedom. He has a channel as well. If you're looking for someone who likes to spice things up, if he actually watches this, he might chuckle, he might not. Bradley Talks Money. He is all over Blossom. He has a YouTube channel, although I don't know how often he posts videos, but he is more of a single stock investor. So if you're looking for a variety of information, but he likes to be a bit controversial, maybe, or people perceive him that way, maybe is the right way to put it. The big one is Ben Felix. So the Rational Reminder, if you're looking for evidence-based stuff, so they are great. The only thing that you need to remember is that they actually own a financial company. But the Rational Reminder, I've listened to every episode of the podcast. Very valuable, lots of great guests. And then, so the last guy who I just did, and I was going to mention to you, you may want to talk to him, is Momentum Finance is the name of the channel, but his name is Mo. He's very popular. Again, he's in Edmonton. They have a fairly big portfolio, and it's mostly XEQT. But I really enjoy his content. He's been making videos for like 5 years now, but very grassroots as a Canadian as well. And then some things to read. The Intelligent Investor is a good book. Global Value is a podcast on Spotify. They talk about individual stocks, so if you're looking for some information about them, they kind of go over their metrics and stuff. Yeah, those are the big ones. So For me, I think it all probably started with Brandon Beavis and Canadian in a T-shirt, which is ironic because Brandon is behind Blossom Social. And what I love about Blossom Social is they have a learning section in there where um, influencers and people that work for the company have made videos to help you understand the uber basic stuff, all of the terminology, what a covered call is, what an ETF is, and they've grown on that philosophy. And then obviously people share their comments and stuff, but they're probably the big people. And then I found Ben Felix and the Rational Reminder, and that kind of tied everything together with this philosophy about ETFs.
What's your handle on Blossom so they can find you?
It's the same thing. It's the Crazy Canuck Investor.
I'll one last question. Thanks for giving me your time today. Where'd you come up with that name, the Crazy Canuck Investor?
That's a great question.
Remember that was the first thing that stuck out to me when I was
Yeah.
doing some research. Yeah.
So if you're into the skiing world, the Crazy Canucks were a group of Canadian skiers in the 70s and the 80s. So you have Steve Podborski, Ken Reed, Dave Murray, Dave Irwin, and Jim Hunter. They make up the Crazy Canucks. And so when I was trying to come up with a name, because a lot of people will just use their name for their channels. There's nothing wrong with that. Some of them are, financially based. It makes it searchable and stuff. I thought like, okay, I'm 50 years old. Who does this at 50? And I was a ski racer when I was a kid. That's what I grew up doing, and I still love it to this day. And so the two just seem to marry well. I know for most when they look at it, they probably laugh and think like, who is this guy? But yeah, that's the story behind is these guys, that's what they did like the fastest you can do on skis downhill. Crazy Canucks. Well, I'm 50 starting at this, so I thought, well, I'm pretty much a crazy Canuck.
I always look at it from a marketing angle. That's what I always look at everything through that lens. The first thing I thought before I even watched any of your videos, I just was researching people and you showed up in my feed. I was
Oh,
looking for, I saw the Crazy Canuck Investor. Immediately before I clicked, I went, "Oh, this guy will tell me the truth." That's what it was. I was like, because you're trying to filter through bullshit when it comes to investing advice. And then when I saw you, I went, "Wait a second. Okay, cool. Now this is like a normal guy, the Crazy Canuck Investor." I'm like, he's just gonna tell me what's going on. People need that. Financial advice like this, it's like, what are you doing? Whether I take your advice or not, I just want to know what you're up to. Kind of the point of this podcast, by the way, is when I talk to a lot of people in the space, it's like, hey, what are you up to? And then I share what I'm up to. It's like, oh, we're pretty different on a lot of stuff. But then people can just see what other people are doing and spending their money on and pick and choose, cherry pick little things that kind of resonate with them.
and that's the truth. That's why I started it was I just wanted to share these things as I learn. And believe me, there is some mistakes in there. I'm not afraid to admit it. They're not catastrophic, but these are lessons learned. And I didn't have a resource like this. And you pointed out too, there's some people in the space now that when you watch their channels, they are influenced in different ways to say certain things. So you kind of have to be a bit careful. You can't just take it as gospel. And I like how you sort of framing what my material is. I think that's what it is, and I hope it is, and I want people to benefit from that. I'm very open to questions. I love the comments in there. Some people challenge me. That's what I want. This is kind of like education for me too. So
What's your upload schedule look like? How often are you trying to post?
yeah, so that's a tough one as a busy dad and husband and working. Uh, Two was where I started. And then I got up to three, and then I was looking at one a week, but the one a week is schedule. The editing takes a lot of time, and it's been like an evolving thing. Um, when you edit, even like a podcast like this, if you want to introduce cuts and you want to overlay things, that takes a lot of time. That's where most of my time is spent. I'm pretty good at getting the video done. It's the editing that takes the longest. And so that I'm kind of in that three a month right now. And that, and also I have to not do it with around the family too. It has to be done on my own time. So sometimes that's late at night. I don't know if
Yeah,
you can
that's
resonate with that.
100%.
Or like I'm at home today because everybody's at school and my wife's at work. So that was what allowed me to be able to do this during the day. So I don't
Mhm.
want to interfere with family time.
Yeah, it's essentially what I am. Like, I'm working on my business. I'm running during the day, then it's family time uninterrupted, and then you just find yourself at nighttime recording investing guide for the audience, and you're trying to keep your energy up the best you can while also give the information and not look, for me, just not look too tired. For editing, for me, I have some editors and stuff who do the guides, but for the podcast side, currently I'm editing it myself because like, how do you get people to edit a 2 hour podcast? But luckily I barely do editing. It's still though, it's a small amount of overlay, a small amount of captions on stuff on a 2 hour podcast. It's like, that's a lot of time that I just don't have.
Yeah.
So then I got to figure out a solution to that pretty fast here because as of talking right now, I have 4 or 5 podcasts just sitting on the shelf because they haven't been touched yet, that they're just like, I'm like, oh my God, I gotta like edit these and do stuff with them. Right. So
Yeah, having a schedule is kind of what I've realized is like planning out. But the thing about the investing space is news changes things. So if Trump says something, the market takes a change, there might be something that's important to share. And you might have, like, I was able to get 2 videos done, but then I couldn't edit them. But the idea was to have material set up that I could then have it posted on a schedule. But that can change, unfortunately, I find in the investing space, because that subject might not be important. So I lean back on the fact that, wait a minute, this is my journey. So it doesn't really matter what the news says, because ultimately this is me sharing my journey. So I'd like to get ahead of the curve a bit so that I can edit, have a video in the pipe, and then the next one, like you say, you have them sitting there, but then editing them, it takes the longest.
I thought about having news-based content, but I was like, I'm not willing to go into that grind because people who do news-based content are pumping it out every single day. It's all like, you got to get those views in the first 48 hours. So like the focus primarily for at least my channel is when it's a guide of some sort, like, hey, top 3 ETFs, is evergreen. It can sit there for the whole year.
Exactly.
So maybe the yields might be slightly different, stuff like that, but really the information is good. You can probably check back in 2 years and the information's still good, right?
Yeah.
That's that. And then the podcast, like what we're talking about, will still make sense in a month. We'll still make month in 2 months. It can sit on the channel for a year and it'll be fine. Because we're talking about overall psychology, overall investing techniques, just your story and stuff. So like everything is more or less evergreen that I focus on, and that way you can schedule it.
So that's something else that I look at is, so initially I started doing the idea like, here's my portfolio, how it's performing, and here's a subject, and I would tie that subject in at the end. But I realized that as the portfolio grows, it's like, oh, I don't really need to talk about the portfolio every day. People are more interested in either a single subject or the portfolio. So the video that you mentioned that blew up, I was totally surprised. The reason I think that video blew up is because I introduced this hanging idea at the beginning, which was Questrade sent me an email, and then people were hanging on to find out what that was all about. But those videos, when I talk about the portfolio, those ones seem to do the best, because that's what people, like you said, they're interested in. Like, what is it that you're investing in? What is making this, whatever, 10, 20% return? And I think that's what's crazy is I'm not doing anything special here. I'm literally following some ideas and notions that I brought from other people, and then I've implemented them, and I'm tweaking them, I think is kind of where I'm at now. I'm at the tweaking stage to, like you say, I know I can cut a few things out, but at the end of the day, the core is here. So yeah, it's not a grind anymore. It's almost set it and forget it. The real trick is in taking the money that you have to get it going. Now I have it set up automatically, which is also important.
All right, Darren, thank you so much for talking to me today, guys. Check out the crazy Canadian investor.
The crazy Canuck investor.
Canuck. Sorry, Canuck. And I should know that. I have his link in the first link in the description. Check out the first pinned comment as well. You'll see the link there. Make sure you subscribe to his channel. Follow along with his journey. Let's make it to retirement with this man. Let's figure this out. I'll be using you as my main retirement case study to see how you do it. So this is great. Thank you very much. I enjoyed talking with you today.
You too, Gary. It was great. Thanks.